Hello and welcome. Today we're going to demystify the pretty complex world of cryptocurrency taxation here in Canada. The whole point of this explainer is to give you clear, academically grounded guidance for navigating what can be some very confusing tax laws. So let's get started. Just so you know where this information is coming from, this presentation was prepared by me, Dr. Samir Al-Rishani, with some AI assistance to make sure we have a really thorough and well-structured analysis of the current tax landscape for these digital assets. So here's our roadmap for today. We're going to break this down into 5 key sections. First, we'll define what a taxable event actually is. Then, we'll get into the crucial difference between business income and capital gains. After that, we'll explore some smart tax minimization strategies, look at using tax-advantaged accounts, and we'll wrap up with the nuts and bolts of reporting and compliance. All right, let's dive right into our first section, defining taxable crypto events. The fundamental question here is pretty simple. When does your activity with cryptocurrency actually get the attention of the Canada Revenue Agency? This is the big question, right? To get to the answer, we have to be really precise about which activities the CRA considers a taxable event. Getting this distinction right is absolutely the first step for anyone who wants to stay compliant and plan their taxes effectively. Now, take a look at this. On the left, we have the non-taxable stuff. This is pretty straightforward. If you're just moving your own crypto between your own wallets, say from an online exchange to a hardware wallet for safekeeping, that's not a taxable event. Nothing has been sold or traded. But on the right, these are the actions the CRA is watching. Trading Bitcoin for Ethereum, for example, cashing out your crypto for Canadian dollars, or even giving crypto away as a gift. All of those are taxable. And that all hinges on this one critical legal term, disposition. This is the trigger for a taxable event. In the eyes of the CRA, a disposition happens anytime you give up ownership of that asset. That includes selling it, trading it for something else, or gifting it. Each one of those is a disposition, and that means it has to be reported. Okay, that brings us to our second section, where we tackle the difference between income and capital gains. I'd argue this is probably the single most important classification in crypto tax, because it directly and significantly impacts your final tax bill, your bottom line. And this quote, which is based on the CRA's own guidelines, really hits the nail on the head. It all comes down to your behavior. Are you acting like a business with a lot of frequent short-term trades? Or are you acting like an investor with occasional long-term holds? The answer to that question determines everything. Let's break this down with the table here. You can see the factors the CRA is looking at. High trading frequency, short holding periods, a sense of regularity, that all points towards business income. The opposite, low frequency, long-term holds, points towards capital gains. But look at that last row. That's the knockout punch. 100% of business income is taxable, but with a capital gain, only 50% of it is subject to tax. Okay, I know these rules can feel a bit abstract, so let's use a really practical example to make this crystal clear. We'll walk through a simple scenario to show you just how big of a financial difference this classification makes. All right, let's say you made a profit, a gain, of $100 from a crypto sale. A nice, simple, clean number for us to work with. Now, look at this chart. If that $100 profit is classified as business income, the entire $100 is added to your income and gets taxed. But if it's treated as a capital gain, only half of it, $50, is actually taxable. That $50 is what gets added to your income and taxed at your marginal rate. That 50% inclusion rate is a massive advantage. So that leads us, quite logically, into our third section, tax minimization strategies. See, now that we understand the rules of the game, we can start talking about some proactive ways to legally and effectively manage your tax liability. So let's talk about 3 key strategies. The simplest one, just hold your assets. You don't realize a gain for tax purposes until you actually sell or dispose of it. Second, you can time your sales. It might make sense to sell and realize profits in a year where your other income is lower, putting you in a lower tax bracket. And third, and this one is so important, you can strategically harvest your losses. And I really want to pause on that last point for a moment. It is so important to shift your mindset here. A capital loss isn't just a bad day in the market. From a tax planning perspective, it is a valuable financial tool that you can and should use strategically. So you're probably asking, how exactly does that work? Well, you can use those capital losses to cancel out capital gains you have in the same year, and not just from crypto, but from stocks, from real estate, any capital gain. If you have more losses than gains, you can carry them back up to 3 years to get a refund on taxes you already paid. Or you can carry them forward indefinitely to use against any future gains. That flexibility is incredibly powerful for long-term planning. All right, let's move on to our fourth section, using tax-advantaged accounts. This is a very specific strategy that can allow you to shelter your investment gains from tax completely by using special registered accounts. Now, this is an area where you have to be extremely careful. There's a critical distinction to make. Inside registered accounts like a tax-free savings account or TFSA, or a first home savings account FHSA, you are allowed to invest in regulated products like crypto exchange-traded funds or ETFs. What you are not allowed to do is hold the actual crypto coins directly. The CRA does not see them as qualified investments for these types of accounts. And the benefit of doing this is, well, it's profound. Any capital gains, any dividends, any growth you have on those permitted crypto ETFs inside a TFSA or an FHSA is completely 100% tax-free. When you take the money out, you pay zero tax. It's the most powerful form of tax sheltering we have for investors in Canada. And that brings us to our final and very practical section, reporting and compliance. We've gone through the theory, so now let's focus on how you actually apply this, how to file your taxes correctly, and, just as important, what to do if you've made some mistakes in the past. Okay, this is a question I get all the time. It's a real point of anxiety for a lot of people. The rules weren't always as clear, and a lot of people might have trades from a few years ago that they never reported. So, what's the right way to handle that situation? Luckily, the CRA has a formal pathway for this. It's called the Voluntary Disclosure Program, or VDP. To qualify, you have to meet 4 specific conditions. First, your disclosure has to be voluntary. That means the CRA can't have contacted you about it already. Second, it has to be complete. You have to tell them everything. Third, the situation has to be one that would normally involve a penalty. And finally, the tax filing has to be at least 1 year overdue. If you meet these criteria, you can get significant relief on penalties and interest. Okay, so what about for your current taxes? Well, the actual filing process is pretty straightforward once you know where to look. If you're an individual reporting capital gains, you'll use Schedule 3 on your T1 personal tax return. If your activity is considered a business, then you have to use Form T2125, which is the Statement of Business or Professional Activities. In either case, having meticulous records is absolutely key. So I'll leave you with this final thought to reflect on. Now that the rules are clearer, you really have to ask yourself, is your crypto strategy just built to chase the highest possible profit? Or is it designed for the best after-tax return? Because believe me, the most successful and sophisticated investors, they always consider both.